Hi, I'm Candis Fitch, Portfolio Manager at IAIC, and welcome to another episode of In Focus. Today, I'm joined by fellow Portfolio Manager Steve Cornell, who is responsible for our finance sector. Thanks for joining us again, Steve.
Thanks for having me, Candice.
So, last quarter, you and I chatted, and there had been a lot going on in the finance sector with multiple regional bank failures in the US, which ended up causing some volatility for the whole financial sector. How have banks reacted since all of that volatility in March?
Well, that's a great question. And the answer really depends on which banks we're talking about. Is it the large systematically important banks or the smaller regional banks? Are we talking Canadian or US banks? And so to answer that, at a high level, if we look at the second quarter US and Canadian finance sector index performance, which includes all finance companies in the index, big and small, we see that the S&P 500 finance sector price index was up 5.3% in the second quarter. And that really helped offset the weak first quarter where we saw prices fall 5.6% thanks to the bank collapses in March. After 2 quarters, that puts the S&P 500 finance sector index down slightly year to date. And then looking at Canada, the TSX finance sector price index gain was steady, notching another 2% price gain for the quarter, putting the TSX finance sector up 4% year to date. So the second quarter Canadian and US finance indices clearly indicated the market shock generated by the fear of a 2008 financial crisis back in March when we saw those banks collapse. The market is over it, and clearly the indexes and those positive returns in the second quarter highlight that. And then when you drill into the S&P 500 index, you can see that within the US index, the weakness really came from the smaller US regional banks. And as you mentioned last quarter, we presented many reasons why we believe the March bank failures were not the beginning of a repeat of the 2008 financial crisis. Instead, we believe the Q1 bank failures in March stemmed from company-specific problems and risks at poorly managed smaller US banks, specifically a few small and mid-sized US regional banks. And I mention that because this week, the headlines reported that Moody's had downgraded US banks, which reignited March fears about the health of the US banking sector and did spark some new bank price volatility. But again, as expected, the downgrade was specific to a few small and mid-sized US regional banks and not the big systematically important banks in the US or Canada. Bank failures and deposit runs have stopped since March, and reported Q2 bank earnings came in better than expected for most banks we favor. And we favor the large global and domestic systematically important banks, such as our US and Canadian bank core picks, Royal Bank, TD, JP Morgan, Morgan Stanley, Bank of America, and Goldman Sachs.
Right. So it sounds like that downgrade was a little bit of clickbait on the news sites. Knowing that IAIC likes to focus on fundamentals and not fall prey to the noise in the news, how are earnings actually looking for the finance sector of those banks you mentioned?
Well, reported results for Q2 by the banks we favor were better than expected. Most beat Q2 earnings and revenue estimates, just as they did in Q1. In the last few quarters, we have highlighted two trends among the banks in their earnings. One trend was the slowing rate of net interest margin expansion, and the other was reserve increases for bad loans. And the reserve builds continued in the second quarter, and delinquencies, even though they built reserves, delinquencies remained below pre-pandemic levels for most product loans at most banks, indicating a pretty resilient consumer and economy. However, statistical evidence from JP Morgan and the New York Fed show 30-day delinquencies for credit cards and auto loans are now at or above pre-pandemic levels. So we expect reserve builds to continue. Net interest margins reversed their trend and contracted at many banks in the second quarter. However, the contraction was small and margins remain very healthy. So the higher for longer expected federal funds rate forecast should help current net interest margins, or at least maintain the nice spreads we have right now. Long-term fundamentals remain attractive for the banks with high and growing dividend yields, good ROEs, growing earnings, and significant excess capital compared to the required regulatory minimum levels.
Right. So speaking of regulatory stuff, we know that the finance sector is very heavily regulated. With all of this stuff that came out in the news, higher interest rates, the banks were put through a stress test. Can you talk to us a little bit about the results of that stress test?
Yeah, sure. The market received good news from the recently published 2023 Federal Reserve stress test results, which indicate the U.S. financial system remains very well capitalized. The results indicated the U.S. global and domestic systemically important banks have more than enough capital to handle the most recent supervisory stress test scenario. Our core picks, JP Morgan, Morgan Stanley, Bank of America, Goldman Sachs, as well as Royal and TD's U.S. group holdings are all required to participate, and they all demonstrated adequate capital under the Fed's adverse economic scenario. And that paved the way for implementation of bank capital plans, including share buybacks and dividend increases. Most have announced buybacks or dividend increases since the positive 2023 Fed test results were published. Buybacks reduce shares outstanding, which increases earnings per share, which will increase share price. Dividend increases give investors higher income. So both of those capital plans will be implemented by the banks. We have favored the large global and domestic systemically important banks since regulatory reform was initiated following the 2008 financial crisis, because the reform makes these banks safer investments for our clients. Better than expected Q2 results, successful Fed Reserve stress test results, and persistent low unemployment all add to our continuing constructive view of our core systemically important bank picks.
Awesome. If I can sum some of this up in, plain English for our folks at home, all of this is good news. So buybacks increased, dividends increased, and that stems from financial health and stability of these banks, correct?
Absolutely. Yeah.
Wonderful. Well, thanks, Steve, for your time today and sharing your thoughts with us. If anyone has any questions about today's episode, please feel free to reach out to your financial planner or portfolio manager.